What if I told you that the biggest opportunity in silver is happening right now, in plain sight, and most people are going to miss it completely? Not because the information is hidden, not because it requires special access or privileged knowledge, but simply because most people do not understand what they are actually looking at when silver prices drop hard and the headlines turn negative. That is exactly what we're going to fix today. Right now, silver is sitting around $67 per ounce. For a lot of investors, that number feels confusing and maybe even discouraging. Not long ago, silver was trading above $90. It ran hard, it made headlines, it excited people. And then it dropped, sharply, painfully, in a way that shook confidence and caused many investors to either panic sell or walk away from precious metals entirely. And that reaction, that panic, that confusion, that desire to just get out and stop watching, that is the most expensive mistake you can make at exactly this kind of moment. Because here is what is actually happening. This is not a collapse. This is a reset. And understanding the difference between those two things is the foundation of every successful long-term commodity investment I have ever seen work out for patient, disciplined investors. Let us start from the beginning and build a clear picture of what has been happening in the silver market. Silver moved from the $60 range all the way above $90 in a relatively short period of time. That kind of move attracts attention. It brings in momentum traders, emotional buyers, social media-driven speculation, and people who see a rising price and assume it will keep rising indefinitely. These are what experienced investors call weak hands. They are not buying based on fundamentals. They are buying based on fear of missing out. And when the price eventually pulls back, as it always does after a sharp run, those weak hands sell. They panic, they exit, and they drive the price lower, faster than the fundamentals alone would justify. That is the shakeout phase, and it is a completely normal and expected part of every single commodity cycle that has ever existed throughout the entire history of financial markets. Markets do not move in straight lines. They never have, and they never will. They pump, they pull back, they consolidate, they shake out the emotional participants. And then, when the foundation is clean and the weak hands are gone, they move higher again, typically faster and further than most people expected. What you are watching in silver right now is the shakeout phase. The drop from above 90 down to the mid-$60 range forced out the emotional buyers. It punished the people who entered without a plan, without understanding what they owned, and without the patience to hold through volatility. But here is what is equally important to understand. While retail investors were panicking and selling, smart money was watching, quietly, patiently, and in many cases, quietly accumulating at prices that the emotional sellers handed to them. This is the dynamic that repeats itself in every commodity cycle. Emotional investors transfer wealth to patient investors through their own panic. And the price drop that feels like a disaster to one group of people feels like an opportunity to another. The question you need to answer for yourself right now is, which group do you want to be in? Why silver is so volatile? Now let us talk about something that confuses a lot of investors. Why does silver move so dramatically compared to gold? Why does it pump harder and crash faster? And why does that volatility actually represent opportunity rather than danger for the investor who understands it? The answer comes down to silver's unique dual identity. Gold is primarily a monetary metal. Its value is driven by its role as a store of wealth, a hedge against inflation, a safe haven during times of fear and uncertainty, and increasingly as a strategic reserve asset that central banks around the world are accumulating at historic levels. Gold's price is driven almost entirely by monetary and macroeconomic forces. Silver is different. Silver is both a precious metal and a critical industrial commodity simultaneously. And that dual identity means silver responds to a much wider range of economic forces than gold does. On the monetary side, silver reacts to inflation, to currency devaluation, to interest rate changes, and to the same fear and uncertainty that drives gold. When investors are scared and seeking safe haven assets, silver benefits alongside gold. But on the industrial side, silver reacts to economic growth, to technological development, to manufacturing demand, and to the global energy transition. Silver is a critical component in solar panels, in electric vehicles, in advanced electronics, in medical technology, and in virtually every cutting-edge technology sector that is growing fastest in today's economy. Solar panels alone require enormous quantities of silver for their conductive properties. The global push toward renewable energy is creating a demand for silver that is structural, long-term, and accelerating. Electric vehicles use silver extensively in their electrical systems and battery management technology. Every data center supporting the artificial intelligence revolution requires silver in its infrastructure. This industrial demand does not go away when prices drop. If anything, it continues to grow regardless of what silver's spot price is doing on any given day. The factories building solar panels still need silver. The car manufacturers building electric vehicles still need silver. The technology companies building the infrastructure of the modern economy still need silver. And here is the critical supply-side reality. Silver mine production has been relatively flat for years. New silver discoveries are increasingly difficult and expensive to develop. Unlike dedicated gold mines, much of the world's silver production comes as a byproduct of mining other metals like copper and zinc. That means silver production does not respond quickly to rising prices the way a primary silver mine might. You cannot simply decide to produce more silver overnight because the price went up. So, what you have in silver is a unique combination: growing industrial demand meeting constrained supply, combined with its monetary role as a hedge against inflation and currency weakness. That combination creates the conditions for significant price volatility in both directions. When sentiment turns negative, silver drops hard because leveraged positions unwind quickly. When sentiment turns positive and the fundamental picture becomes clear to more investors, silver can move violently to the upside in a very short period of time. That volatility is not a weakness, it is a characteristic. And for the patient, informed investor who understands the cycle, that volatility creates the entry points that make real wealth building possible. Silver price prediction short term. Now let's talk about numbers and realistic expectations for silver in the near term. With silver currently sitting around $67 per ounce, the honest short-term picture involves navigating a complex and challenging market environment. Interest rates remain elevated. Dollar strength continues to create headwinds for precious metals priced in dollars. Global economic uncertainty is keeping many investors cautious and risk-averse. And the emotional damage from the recent drop from above 90 is still fresh in the minds of retail investors who have not yet regained confidence in the silver story. In this environment, the realistic short-term range for silver is between $60 and $80. And I want to be very clear about what that range means and what it does not mean. It means volatility. It means fake breakouts in both directions that will trap impatient traders. It means moments where silver looks like it is about to break higher that reverse without confirmation. And it means moments where silver looks like it is about to break lower that recover before the real downside support levels are tested. This is a trader's market in the short term, and unless you are an experienced active trader with strict risk management discipline, trying to trade every short-term move in silver right now is one of the fastest ways to erode your capital and your confidence simultaneously. For the long-term investor, the short-term range is not the story. It is simply the environment you have to be patient enough to sit through while the bigger picture develops. The mistake most investors make is confusing short-term price action with long-term value. A silver price of $67 today does not tell you where silver's value is. It tells you where the market's current sentiment is. And sentiment and value are two entirely different things. Value is determined by supply and demand fundamentals over time. Sentiment is determined by fear and greed in the moment. Right now, sentiment is negative, and that is creating a gap between where silver is priced and where its fundamentals suggest it should be over a longer time horizon. That gap is exactly what patient investors are positioned to benefit from. Silver midterm outlook. Now, let us look further out because this is where the silver story becomes genuinely compelling for serious long-term investors. As we move through the remainder of this year and into 2026, the conditions that have been creating headwinds for silver have a realistic pathway to reversing. Interest rates that have been suppressing precious metals prices are widely expected to begin coming down as central banks respond to slowing economic conditions. A weakening dollar environment historically creates significant tailwinds for silver and gold as assets priced in dollars become more attractive to international investors. Meanwhile, the structural industrial demand for silver continues to build regardless of monetary policy decisions. The global energy transition is accelerating. Solar installation targets around the world are being revised upward. Electric vehicle adoption continues to grow. And the technology sectors consuming silver in their infrastructure are expanding at a pace that shows no signs of slowing. When you combine easing monetary policy conditions with structurally growing industrial demand and supply constraints that have not been resolved, the midterm outlook for silver becomes one of the most compelling cases in the commodity market. A realistic midterm price range for silver in 2026 is between $80 and $120 per ounce. And I want to emphasize the word realistic. This is not hype. This is not a promise. This is a projection based on the confluence of monetary, industrial, and supply factors that are developing in real time. The key insight here is timing and patience. Silver does not move gradually toward these kinds of targets. Silver tends to move in bursts. It consolidates for extended periods and then moves quickly and dramatically when the conditions align. The investors who are already positioned before those bursts happen are the ones who capture the full magnitude of the move. The investors who wait for confirmation, for the move to already be obvious, for the headlines to turn positive again, those investors consistently enter too late and capture only a fraction of what was available to those who were patient enough to hold through the difficult consolidation phase. Right now, silver is in that consolidation phase, the difficult, uncomfortable, test your conviction phase that always precedes the significant moves in commodity markets. And the evidence suggests that the conditions required for the next significant move higher are gradually falling into place. The extreme scenario and the short squeeze. Now I want to talk about something that most mainstream financial commentary completely ignores when discussing silver, and that is the possibility of a silver short squeeze. A short squeeze occurs when a heavily shorted asset, meaning an asset where many market participants have placed bets that the price will fall, experiences a sudden surge in demand or a reduction in supply that forces those short sellers to buy back their positions quickly to limit their losses. When that happens, the buying pressure from short sellers closing their positions combines with new buyers entering the market and drives prices violently and rapidly higher in a very short period of time. Silver has historically been one of the most heavily shorted commodities in the world relative to its physical supply. The disconnect between the amount of paper silver contracts trading in financial markets and the actual physical silver available for delivery has been a subject of serious analysis by commodity market researchers for years. If a genuine supply shock were to occur at the same time as a surge in industrial or investment demand, the short squeeze dynamics in silver could create price moves that most conventional analysts would describe as impossible. In an extreme short squeeze scenario, silver prices of $150, $200, or potentially even higher are not outside the realm of possibility. Now I want to be very careful about how I present this, because intellectual honesty requires acknowledging that extreme scenarios are by definition not the base case. They are the tail risk, the low-probability, high-impact scenario that disciplined investors consider as part of their overall assessment, without allowing it to become the primary driver of their decision-making. The reason I mention it is not to create excitement or drive emotional buying decisions. I mention it because understanding the full range of possible outcomes, from the conservative midterm case to the extreme short squeeze scenario, is what allows you to make genuinely informed decisions about your position sizing, your time horizon, and your risk management strategy. If you hold a small, well-considered silver position as part of a diversified portfolio, and silver never experiences a short squeeze, you still benefit from the midterm fundamental case. If a short squeeze does occur, that same position delivers returns that most conventional investments cannot match. That asymmetry, the relationship between the downside risk and the potential upside, is what makes silver one of the most interesting risk-reward propositions in today's investment landscape for investors who approach it with the right mindset and discipline. The biggest mistake investors are making right now. Now, I promised you at the beginning of this video that I would share the single biggest mistake investors are making in the silver market right now. And this is the insight that I genuinely believe has the potential to change how you invest permanently if you internalize it fully. The biggest mistake is not buying at the wrong price. It is not picking the wrong entry point. It is not even failing to understand the fundamentals of silver supply and demand dynamics. The biggest mistake is allowing short-term price pain to override long-term fundamental thinking. Every single time a commodity with strong long-term fundamentals experiences a significant price correction, the same pattern plays out in the investor community. People who understood the fundamentals and made a deliberate decision to invest suddenly find their conviction disappearing as the price moves against them. The story they told themselves when they bought, about supply constraints and industrial demand and monetary debasement, starts to feel less real when the price is dropping and social media is full of people saying the move is over. And so they sell, not because the fundamentals changed, not because the long-term thesis broke down, but because the short-term price pain exceeded their emotional capacity to hold through it. And then, 6 months or a year later, when silver is trading significantly higher, those same investors watch from the sidelines, having sold exactly at the wrong moment, having transferred their upside potential to the patient investors who held through the same volatility that forced them out. I have watched this pattern destroy more potential wealth than any other single mistake in investing. And I have watched it happen specifically in silver more times than I can count, because silver's volatility makes it one of the most psychologically challenging assets to hold through corrective phases. The solution is not to become emotionally numb or to ignore price movement entirely. The solution is to build your investment conviction on a foundation of fundamental research so deep and thorough that short-term price movement cannot shake it. When you truly understand why you own silver, not just because someone told you it was going up, but because you studied the supply and demand dynamics, because you understand its monetary role, because you see the industrial demand trajectory with your own eyes, that understanding becomes an anchor that holds you in your position through the volatility that would otherwise shake you out. Research is not just a step you take before investing. It is the foundation that makes everything else possible. And right now, at a moment when silver is sitting at $67 after dropping from above 90, that research and the conviction it builds is the difference between capturing what this market is offering and watching someone else capture it while you stood on the sidelines. Final insight and warning. Before I close, I want to leave you with something I want you to carry with you beyond this video and into every investment decision you make going forward. Every major wealth-building opportunity in the history of commodity markets was uncomfortable before it was obvious. The investors who built generational wealth from silver, from gold, from oil, from any real asset. They were not comfortable when they made their moves. The market was uncertain. The headlines were negative. The price was moving against them or sitting frustratingly flat. Doubt was real and justified. But they held to their research. They trusted their fundamentals. They managed their position sizes to ensure they could stay in through the volatility. And they let time do the work that patience and discipline always eventually reward. That is the invitation silver is extending to informed, patient, disciplined investors right now. But here is the warning you must take seriously. None of this works without discipline. Buying silver without a clear plan, without understanding your position size relative to your overall portfolio, without knowing your time horizon, without having a strategy for managing further downside. That is not investing with conviction. That is gambling with a fundamental narrative attached to it. Know why you are buying. Know how much you are buying relative to what you can afford to hold to further volatility. Know your time horizon. And commit to not letting short-term price movement override your long-term fundamental reasoning. Silver at $67, with the supply constraints, the industrial demand trajectory, the monetary debasement environment, and the potential for significant upside across multiple scenarios. This is a moment that informed investors will remember. Make sure you are on the right side of it. This is not financial advice. Every investment decision you make is your own responsibility. Always conduct your own thorough research and consult a qualified financial professional before committing any capital to any investment. If this video gave you a clearer and more complete picture of the silver opportunity right now, please like it and share it with someone who needs to hear this perspective. And subscribe to the channel because we are going to keep delivering honest, grounded, research-based financial education for serious long-term investors who are committed to building real and lasting wealth. Stay patient, stay disciplined, and always do your own research. Posted by Kevin Price, Real Assets, Real Education, Real Wealth.